Well, good morning, everyone. Welcome to the Gateway Regional Chamber of Commerce 10th Annual Economic Outlook Summit. Today, our topic is the future of inflation. And if you have been anywhere watching the news recently, you know that this is probably the most discussed topic in economics right now. First time in decades that we have seen this kind of level of inflation. And so I am really glad that we are going to have an interesting discussion. We have three world-class economists with us today to take us through some of the different aspects of inflation, where the economy might be going, how we might be able to solve these problems. So just a whole lot of issues to address and discuss. I want to start out by thanking our sponsors this morning. They are Horizon Blue Cross Blue Shield, TD Bank, Northfield Bank, Spencer Savings Bank, and the Beacon Financial Group. So obviously, a lot of people in the banking and finance area are going to be very interested in this discussion. So, as I said, we have three world-class economists with us this morning. The first one that you will be hearing from is Mark Zandi. Mr. Zandi is the chief economist for Moody's Analytics, where he directs all of their economic research. And, you know, if you watch TV, if you listen to the radio, I'm sure that you have seen or heard him often. He appears on CNBC, NPR, Meet the Press, CNN. So just a lot of different places. Recently published a book called Paying the Price, Ending the Great Recession and Beginning a New American Century, which talks about the Great Recession and what we did with monetary and fiscal policy to overcome that time. So just a terrifically well-informed person to talk with us this morning. You'll also be hearing from Bill Dudley. Mr. Dudley is a senior research scholar at the Griswold Center for Economic Policy Studies at Princeton. But from 2009 to 2018, he was the president and chief executive officer of the Federal Reserve Bank of New York. In that capacity, he served as vice chairman and a permanent member of the Federal Open Market Committee, the group that is tasked with formulating the country's monetary policy. Prior to joining the bank, Mr. Dudley was a partner and managing director, as well as chief economist for Goldman Sachs and Company. And then finally, we are going to get a totally different view from across the border. We have James Marple with us this morning. James is the managing director and senior economist of the TD Bank Group. In this position, he leads a team of economists that provide policy analysis and forecasts to TD's clients and stakeholders. The team delivers a wide scope of research covering both the US, Canadian, and global economies. So I think it's going to be fascinating to have kind of a Canadian perspective on what's going on in the US markets and how that might affect Canada and other countries. So with those introductions, I'm going to turn it over to Mr. Zandi, and he's going to take us through his presentation.
Thank you, Jim. It's good to be with you. Thanks for the invitation and to the Chamber of Commerce. It's really an honor and a pleasure to be here. Just for sake of disclosure, I should also say I'm on the board of directors of MGIC. MGIC is one of the nation's largest mortgage insurers, and I'm also the lead director of Reinvestment Fund. Reinvestment Fund is the largest CDFI, community development financial institution in the country. We make investments in underserved communities across the country. So with that as an introduction, it's good to be with you. I'm going to do two things in my remarks. First, I'm just going to give you a sense of where the economy has been and where I think it's headed, kind of a baseline outlook, a middle of the distribution of possible economic outcomes. And then, of course, given the uncertainties here, which are considerable, part two, I'll consider the risks, mostly focused on the downside. So with that, we can turn, I have a few slides. So with that, we can turn to the first slide. Thank you for that. I think this nicely shows where we've been and where we're headed, at least my sense of where we're headed. This shows employment, millions of jobs monthly, January of 2019 through the end of 2024. You can see where history ends and forecast begins. That's the shaded part of the chart. You can see the recession back March, April of 2020. Very short, 2 months, the shortest in history, but obviously very severe. We lost 22 million jobs in that period. GDP, the value of all the things we produce, that fell about 10% peak to trough. And just for context, if you go back to the financial crisis a little over a decade ago, a downturn that I thought was a doozy, GDP fell about 4% peak to trough, just to give you a sense of magnitude. You can see we've come a long way back. We've regained 18 million of the 22 million jobs we've lost, so we're still down about 4 million. A lot of the recovery is largely due to containing the pandemic to a significant degree, but also as a result of the very aggressive monetary and fiscal policy response. Of course, the Federal Reserve early on established a range of credit facilities to insulate the financial system and markets from what was going on in the economy. That was quite successful. Lowered short-term rates to the zero lower bound, and of course we're still there today, and engaged in quantitative easing bond buying, which the Fed is just about ready to start winding down here. On fiscal policy, massive fiscal support, beginning with the CARES Act back in March of 2020, and extending through to the American Rescue Plan in March of 2021. And that added about 5 trillion in support. That's about 25% of GDP. So that's, quite significant. Again, for a little bit of context, in the financial crisis, policymakers provided about support of equal to about 10% of GDP. And in the current pandemic, looking across the globe, the countries that come closest to the U.S. in providing support would include Japan and the UK, and they've provided about half the support we have, about 16% of GDP. So very significant support to get us back to where we are today. You can see the outlook, the baseline. I'm optimistic. I don't think it's going to be quite a straight line, a bit of a bumpy road, but I think the outlook is good. 3 key assumptions. One, that the pandemic will steadily wind down. We've achieved something close to herd resistance. I don't mean that as a medical term, but just to denote the idea that we're going to have future waves of the virus, in all likelihood, that each future wave is going to be less disruptive to the healthcare system and to the economy than the previous wave. So that's a key assumption. Second, we will get passage of the Build Back Better legislation. I'm sure you all saw that the House just passed a $1.85 trillion Build Back Better agenda. This is increased spending and tax breaks for various types of social programs, from child care and elder care to housing and healthcare and climate risk mitigation. I do expect that to get into law in the next 3 weeks. It might be slimmed down a bit given some of the information we just recently received from the Congressional Budget Office around the budgetary effects, but it'll be around that order of magnitude. That's a key assumption. And then third, on monetary policy, I do expect the Fed to wind down. It's already announced it's going to begin tapering QE. That should start imminently if it hasn't already happened. And they'll wind the bond buying down by everything sticks to script by mid next year, and then soon thereafter begin to raise short-term interest rates. And I think they'll normalize rates over through mid-decade, which means putting the funds rate target from the zero lower bound to something kind of around 2.5%, which is, I think, where the federal funds rate should be in the long run. And if everything sticks to script, we'll be back to full employment, broadly defined, mid 3% unemployment rate, a somewhat higher participation rate, higher labor employment to population ratio, by the early part of 2023. So if everything kind of hangs together, then it'll be 3 years from the start of the pandemic to the end. Obviously a long, painful period, but the recovery will be a relatively quick one compared to recoveries we've experienced in past recessionary periods. But the recovery takes roughly twice as long as this one. So from that perspective, a quick recovery. One other thing about the baseline I want to mention, which has relevance to our part of the world, I know you're in New Jersey, I live in suburban Philly, we're neighbors, is that the pandemic will have some longer term consequences, one of which is I think remote work is here to stay. For example, Moody's, my employer, just decided to go virtual, so you can live anywhere you want. You can't move from one country to another, but you can live anywhere in the United States, for example, that you want to live. And remote, and you can see the implications of that in the chart. That this shows the net out migration from urban cores for the nation's 400 plus metropolitan areas to suburbs, exurbs, and rural areas. This is based on credit file data. We get a 10% sample of all the credit files in the country every month. Based on that, we can look, it's anonymized, obviously, but we can see addresses and we can see address changes. So this data is based on that. The last data point here is for the month of September. I just got the October data. I haven't had a chance to take a look at it. I'm showing you, this is a 12-month moving sum, so it's kind of annualized back to 2007 through September of this year. You can see the shaded part of the chart, that's the pandemic, and you can see that the net out migration from urban cores has more than doubled, over the pandemic. It's starting to come in as people start to go back to work, but I don't think it's going to come back all the way in. We're going to see continued outflows. The metropolitan areas that are shown in the chart, those are the top 10 areas where for the biggest increase in net out migration in the pandemic. New York, New Jersey is at the top of the list. About 100,000 more people are leaving the metropolitan area than was the case before the pandemic. And, that will affect long-term growth prospects in the region. Not that the region won't grow, it's just that the rate of growth will be diminished by that. And obviously it'll help support growth in parts of the country, particularly the Southeast and in Texas, where a lot of these folks are moving to. Okay, let's move to the risks. As I mentioned, there are considerable risks. Hard to get your mind around it. So that's the purpose of this risk matrix. Kind of, I think, nicely summarizes all the various downside risks to my generally sanguine economic outlook. Just to acclimate you to the matrix, the horizontal part of the line, the x-axis, is the severity of the risk, the shock. It's kind of a net present value future loss concept. So it's not only about the loss given the shock, but it's the timing of the shock that also matters. If it's longer in the future, then it's going to be less severe by this measure. The y-axis, the vertical axis, is my subjective assessment of the probability of that risk. So, for example, look at the southeast part of the chart, Treasury default. Well, this is unlikely that the Treasury is going to default. Of course, as you know, Congress and administration have to come to terms here relatively soon in raising the debt limit, probably sometime between mid-December and January. They're going to the Treasury is going to run out of cash if the Treasury doesn't raise the debt limit. Low probability that they won't. So the likelihood of the risk here is low. But if they were to fail to raise the debt limit in time and the Treasury didn't make a debt payment on time or didn't pay someone on time, the military or Social Security recipients or even the electric bill, I think that would be cataclysmic for the financial system and the economy. Please go back one more slide. I want to finish this off. You can see that the most significant risk here is the pandemic intensifies, and that goes to the assumption I'm making here is that the pandemic will subside, that we'll get more waves, but each future wave will be less disruptive than the previous one. But obviously, the pandemic can go in many different directions here, and that could be a problem for the economy. I do want to point out one other risk. See, persistently high inflation, to the topic at hand. I do view this as a serious threat. My own perspective is that inflation will moderate significantly by this time next year, that the key reason for the acceleration in inflation currently is the pandemic, particularly the Delta wave of the pandemic, which severely disrupted our economy, but even more so the rest of the world, particularly Asia and Southeast Asia, where a lot of the supply chains begin. And, the vehicle industry is a good poster child for this. A lot of the chip plants in Malaysia shut because the government shut them down because of the Delta. That caused vehicle production around the world to be significantly curtailed, including here in the United States, and that led to shortages and higher inflation. Also disrupted labor markets and shifted the composition of demand. So if that diagnosis is correct, then I do expect that that inflationary pressures will abate, and we won't be talking about inflation a year from now. Finally, though, and you can move to the last slide, the key here around that sanguine view and thus the risk is inflation expectations. If people begin to believe that this higher inflation is here to stay, then we're going to have a different outlook for inflation, for Fed policy, for interest rates in the economy. So far, so good. That's what you see here. This is inflation expectations as embedded in long-term interest rates, 10-year Treasury yields. You can see the latest data point is somewhere south of 2.5%. This is inflation expectations from investors for CPI inflation, consumer price inflation. That's exactly where the Fed would want this to be. So no problem. But if that migrates higher, gets above 2.5%, then that goes to the risk. My outlook will not be the outlook will not be nearly as sanguine as my baseline. With that, Jim, I'll stop and I'll turn the conversation back to you.
Great. Thanks so much, Mr. Zandi. Really interesting.
Please call me Mark, Jim. Please call me Mark.
Okay, Mark. Thanks so much. And let me remind people that if you're following this on YouTube or Facebook, you can put questions into the chat because we will be having a Q&A period a little bit later. So Mr. Dudley has not been able to sign on yet, so we're going to go to Mr. Marple and get his view from Canada and what he's seeing with the inflationary spiral, how long he expects it to go. And I'd also like you to talk a little bit, if you could, about how that's going to affect the Canadian economy and, if you're seeing spillover there. But so please.
Okay, sure. Thanks very much, Jim. And I'll just sort of take on from where Mark left off. Not a lot of light of day between our broad economic outlook. There are similarities. I think we tend to see three themes to the economic outlook. The first is obviously the public health situation, which is still with us, but it seems like we're moving more to an endemic phase of the virus, where we're increasingly learning to live with it. Fewer and fewer countries are trying to completely eliminate COVID, although we still have China with a zero COVID policy, but elsewhere, even countries in Southeast Asia like Australia and New Zealand have come to the realization that, especially as vaccinations and treatments reduce the impact of the disease, that we just have to try to live with it. And so we're not getting the kind of restrictions on activity that we had earlier, but we're still seeing the impact of sort of ongoing increases in cases, most recently in Western Europe, where cases have just exploded now in Germany and other countries as they have loosened restrictions, and they've had to backtrack a little bit on that and do what they can to incentivize vaccinations, which is really the way out of this crisis. But the second theme is obviously, as Mark mentioned, the policy response to the pandemic, especially the fiscal and monetary policy response, which has been truly extraordinary in magnitude, but differs by country. And I think an important point to the inflation discussion, as Mark mentioned, is that it really was much bigger in the United States than in other countries, and we're starting to see that come through in some of the inflation data. And then, the third theme is really the consequences, the both unintended, unexpected, some of them, of the collision of the health situation and the policy response to it. So we're now at a point where we're starting to see inflation rise, and that is a global phenomenon. We've seen accelerated inflation throughout advanced economies, with the notable exception of Japan, where core inflation remains in deflationary territory. It's still a international oddity, but elsewhere Canada, the inflation rate up at 4.7%. We've seen inflation in the UK rise to 4.2% and 4.1% in the Eurozone. I think one thing, notable difference between what we've seen in inflation internationally is in Europe, especially, very much driven by increases in energy prices and shortages of natural gas related to some, idiosyncratic supply side issues there that have made up about half of the increase in inflation in the Eurozone area. So it's abstracting from the increase in energy prices and their secondary impact. Inflation is still pretty close to the 2% mark in inflation. But nonetheless, you see this trend, especially if you try to look at a harmonized type of inflation metric, that increases in transportation costs, energy, and costs of moving items around or people around is really where most of the acceleration in inflation is. And some of that is related to the base effects of the fact that we had inflation really declining and decelerating a year ago, and now we're seeing a year of economic recovery. But I do think it's kind of worth noting also, where we've seen similarities and where we've seen differences. I mean, in the United States now, inflation at 6.2% is at a 30-year high. In Canada, it still has a 4 handle on it, but it's an 18-year high, and in the Eurozone, a 13-year high. So thinking about what has led to some of the differences in the rates of inflation, I mean, I think the first point is I've already made, but what Mark said is that the policy response has been bigger there than we have seen elsewhere. So 25% of GDP spent, and half that in the next nearest country. Canada actually is pretty high up there in terms of its policy supports. I believe even more than especially than Japan and some of the other countries. But the income supports have been different in the way they have been oriented, more in the way of expanding unemployment insurance and giving support to workers who have been laid off, and also through kind of wage maintenance schemes, trying to keep people attached to the labor force and keep them in the job market rather than just direct supports to households, the way we've seen much more use of that in the United States. And as a result, we've seen that in terms of economic output. I mean, the economic output in the United States is now above what it was prior to the pandemic, about 0.5% or so higher in terms of GDP than we were prior to the pandemic. In Canada, for example, GDP is still 1.2% smaller than it was prior to the pandemic. The UK 2.1, Canada 1.2, UK 2.1. The Eurozone is about 0.5% below where it was prior to the pandemic, but you see quite a bit of, obviously, diversity and differences across European countries. France has done very well, just 0.4%. Spain and Italy much further behind, and the biggest in Germany, it's about 1.3% smaller than it was prior to the pandemic. Similarly, that trend of the composition of demand really shifting to durable goods, to goods in general, but especially durable goods, where if you look at the United States, we're about 25%, or was at its peak, higher durable goods spending than it was prior to the pandemic. And we still have services spending, which of course is 65% of output, that is still below where it was. That shift in the composition of demand, I think, is really showing up in higher inflation in the United States. We don't see the same phenomenon in other countries. I mean, Canada has had the kind of shift, but we have not seen durable goods spending 20% above where it was prior to the pandemic. It's closer to 10% above, and even less in the Eurozone. So we've seen where that real run up in prices, especially vehicle prices, that is much more of an American phenomenon than we've seen elsewhere in the world. So that's important, I think, because we're now seeing a situation which demand is healthy. I mean, I think that's true around the world, but I mean, it is important to recognize that countries have had loosened restrictions at various speeds, and after the initial lockdowns, the United States has been quicker to reduce restrictions on activity. By comparison, in Canada, GDP declined in the second quarter of this year as the Delta wave resulted in a pretty major backtracking in terms of economic reopening, especially in the largest provinces in the country. And that led economic activity to decline, where it continued to rebound, especially again driven by strong goods spending. That didn't happen. In Canada, and so we're still seeing those restrictions. I mean, just thinking about this quarter, I mean, the restrictions probably a bit of a setback in Europe. Perhaps again, not as much given they're trying to limit them. But as a result, you've seen just a slower pace of growth as a result to, again, the reaction to ongoing health restrictions. But at the same time, those international kind of shipping backlogs and what we've seen drive up goods prices, we've seen that those have been more severe in the United States. So we've seen that the cost of shipping goods from China to the North America has gone up more. We have more ports that are backlogged than we've seen in Europe relative to Asia, and obviously that has exacerbated some of the challenges. Another I think important point is that the U.S. dollar through 2020 on a trade-weighted basis was depreciating, and maybe relative to other countries, the dollar doesn't have quite the same inflationary impact or deflationary impact given pricing of international goods in U.S. dollars. But for other countries, it can matter quite a lot. For Canada, more reliant on imports, the Canadian dollar strengthened all the way through 2020 and actually reached a high at the beginning of this year, and that tended to reduce the pace of increase of import prices, and something that has led to slightly lower inflation. The one thing, again, just in terms of some of the things we've seen across countries, though, we have seen, and Canada actually epitomizes this, a real increase in not just goods prices, but especially perhaps the biggest good people purchase, and that's in the housing market, where we have seen just phenomenal price growth as mortgage rates fell. And perhaps, I mean, there is maybe a case that some of that consumption that has gone directly into home purchases, of course, there are auxiliary and ancillary spending that comes with the housing market, but we've seen more spending on housing and on mortgages in Canada relative to the US, which maybe has reduced a little bit some of the price growth that we've seen broadly. I think important to note that central bank reactions have been a bit different from country to country. So Canada has already stopped its quantitative easing program. It has not moved in the same way to an average inflation targeting regime as we've seen in the United States. So a little bit worried about being proactive against inflation, and you see that in markets in terms of anticipation of rate increases in Canada as soon as the first quarter of next year. We're still well behind that in the United States, which in some sense is a little bit surprising. I mean, the economy is actually not above where it was prior to the pandemic, although on the labor market, and maybe I'll make this my final point before moving back to questions, is you see this very different labor market performance, and not so much on the unemployment rate, but on the participation of people in the labor market, where we've seen this phenomenon of people leaving the labor market. In the United States, about 3 million fewer people participating in the labor force than there were prior to the pandemic. In Canada, the labor force is larger than it was prior to the pandemic, and we have seen as a result the unemployment rate a little bit more elevated, just because there are more people participating in the labor market, and as a result, we have not seen the kind of wage pressures. And I think similar is true in Europe, by the way, where they've seen the labor force participation hold up better. Still some signs of labor shortages and the same kind of phenomena of having job openings really increase substantially, and there maybe even be more job openings than there are unemployed. But you're not seeing that come through in the kind of wage pressures that we've really seen already start to happen in the United States. I would suspect that will follow, that as we see the labor markets continue to tighten, and similar phenomena in terms of pretty buoyant demand and people returning to work in some of the higher contact service sectors of the economy. But that is one, I think, important differentiating metric that maybe there isn't or shouldn't be as much worry about the potential for wages and prices to go up together and lead to the kind of spiral. So I'll leave my comments there and look forward to some Q&A. Hope everyone's still there. I mean, I have some questions for Mark if you want to.
Actually, we have this conversation every once a year or so before the pandemic. I'd visit James and TD in Toronto, and we'd have a great conversation. Great. We could do this without you, Jim. We didn't really need you.
Yeah, I don't know what happened, technical difficulties, but, I'm glad you two were able to carry on the conversation without me. But I do have actually quite a few questions that have come in. And I really want to start with something very basic. For a long time, the Federal Reserve has been putting tremendous amounts of liquidity into the economy. For many, many years, we've been running substantial deficits at the federal level. Why all of a sudden this spring did we hit a tipping point and inflation took off? What changed so dramatically? And is this inflation across the board, or are we finding that pretty much everything is just kind of going up at the same level, or is this really based on things that are messing up in the supply chain? Either one of you, I'll let you.
Go ahead, Mark. You start.
Well, to answer your question, I think it's the pandemic. It's the Delta variant of the pandemic, which hit really in June, July, August, and peaked in September. And that did a lot of damage to growth, the economy. You may remember Q3 GDP growth came to a virtual standstill. Would have been negative if not for less of an inventory drawdown. And it juiced up inflation in three ways. First, it badly scrambled supply chains. Again, particularly because Delta really hit us hard, but it hit the rest of the world harder, in Southeast Asia and Asia, China, particularly hard. And that's where all the supply chains begin. So Delta was uniquely designed to screw up our supply chains. Second, it messed up our labor markets. You can see there's a great survey done by the census. They've been doing it every 2, 3, 4 weeks since the pandemic, called the Pulse survey. Recommend folks go look at it. Big survey, lots of questions. And they asked for those people not working, why aren't you working? And you can see when the Delta hit, several million more people left the labor market because they got sick or they were taking care of sick family members. And then a couple more million because they were fearful of getting sick. And then the third thing it did is it reinforced what James was talking about in terms of the composition of spending, of demand, pulling it away from travel and restaurants and ball games. You remember back a couple months ago, people were starting to pull back because of Delta. And because we were at home sheltering in place, we've been spending more on goods and durables. And that's where a lot of the inflationary pressures have developed. In fact, if you look at overall consumer spending, the whole shoot and match, durables, consumer services, it's still lower than where you would expect it to be if there had not been a pandemic. So in my mind, it's not really demand, maybe a bit of the composition of demand. It's more about supply in the Delta variant. This is really important because this debate or this discussion about what's causing inflation now, because that goes to the prescription for, it goes to the outlook for inflation and what it means for future policy, particularly fiscal policy. And if you buy into my diagnosis, it would suggest that inflation will moderate as now that the Delta variant's winding down, the pandemic continues to wind down, supply chains get back in order, labor markets get, by the way, you can feel it already happening. The shipping rates from Asia to the US are already starting to fall. They peaked, and you can see it in lots of other data. So if that's the case, we should see inflation moderate. Not next month, next quarter. It's going to take a little bit of time to get everything back into place. But by this time next year, my sense is we won't even be talking about inflation. I don't think it'll be a matter of discourse. In fact, you'll see things that have gone skyward in price, like vehicles, come crashing down in price as soon as production picks up. You'll see outright price declines in lots of different products and services. So, I don't think this inflation we're observing now you can trace back to fiscal policy, the American Rescue Plan, to monetary policy per se. I think it's about the pandemic. It's about Delta and the supply hit to the supply side of the economy because of Delta.
So maybe
you've been smiling there.
Yeah, I mean, I just want to disagree a little bit on the margins, just in terms of, I mean, we have been hit by a bit of a perfect storm, and certainly the supply side issues in terms of that have been driving up prices. Absolutely. I mean, and I agree also that many of those things over the next year should be alleviated. I mean, we've seen sort of capitalism working in terms of already starting to reduce some of those costs, and I don't think we'll be talking about the same kind of impact in these narrow categories that that have been driving up price increases. So I think that's right. But I think we have to ascribe at least some of the increase in inflation to the size of the supports, of the fiscal and monetary supports, that we would not have seen such a surge in demand for durables had we not had the size of those pandemic supports, and alongside zero interest rates that have made it easier to borrow, which are certainly have shown up in the housing market. I mean, no economist at the outset of the pandemic thought that we'd have this kind of housing market with double-digit price growth across the country, and I think that is obviously a direct result of the policy supports. And so I think going forward, one thing I would be a little cautious about is you probably want to keep the inflation rate low enough that people don't notice it. I mean, we look very closely at measures of inflation expectations, and I think that is to Mark's point, that is very important. But I do get a little concerned that we maybe too sanguine just looking at financial markets and looking at the inflation expectations there, that once you get to a point where every news story is about inflation, and people are already talking about that getting into the fact that their wages are not keeping up with inflation, and we are seeing, I mean, the labor market is very tight. There are more despite the level of unemployment, there are more job openings than there are unemployed, and the quit rate is rising and a higher, I mean, not rising, it's at a historic high. So you have that kind of phenomenon, and that is the kind of thing that leads to higher wages. And then I mean, I think there is, I mean, I guess I wouldn't go so far as to say we won't be talking about inflation in a year from now. I think probably the headline inflation rate will be lower, and I think the energy prices especially, I mean, we're starting to see a bit of a supply response there, and we should see actually perhaps, and similarly with vehicle prices, that actually subtract and drag on inflation a year from now. But we probably will still have an inflation rate that's above 2% and maybe a fair bit above 2%. And, depending on how cautious and patient the Fed is in unwinding policy, I mean, that will, I think, determine how much we're still worried about inflation a year from now.
Mm-hmm. So the Fed has always set 2% as its target annual inflation. Is that the right rate that they should be looking for, or they tried to hit it for a number of years and were not able to make it? Do we need to just rethink the way that monetary policy works?
James, why don't you take a crack at it, and I'll go after.
Sure,
I'll respond to what you say this time.
Yeah, that's fair.
I'll take pot shots at you.
That's only fair. Well, I mean, I want to be a bit of a two-handed economist. I think the 2% inflation has a good track record. I mean, it's well known, and I think it's been established, and there's credibility of central banks. Well, maybe not credibility in the fact that they haven't even hit 2%. But I mean, I think you changing that and putting that into a global financial system of adjusting it. I mean, I would do that with a bit of caution. I think there could be some unintended risks and consequences of doing that. I mean, I do understand, the notion that especially we are probably in a world in which the zero lower bound is going to be an issue for policy, given just lower trend rates of growth, slowing population growth across advanced economies. And there is an argument that, hey, we've got inflation up now. It's above 3%. Maybe now we use this as an opportunity to readjust our target and say we're going to target 3% going forward. And again, I mean, the benefit of that largely, I would say, is just in avoiding getting 1 percentage point, 100 basis points further away from the zero lower bound, and ability to use more traditional policy when you have an economic downturn than having to get into asset purchases and other other things, which fair enough have worked, I mean, fairly well, but you could avoid that with a bit higher inflation target. So I don't know, I kind of talked out of both sides of my mouth there, but I would be cautious in changing it, but if there was a time to do it, maybe now's it.
Well, just to add on, I mean, the Fed did change its inflation target. So if you go, and they changed it back in August of last year, and that previously the 2% was thought to be, the inflation target was thought to be kind of a ceiling, that Fed doesn't want inflation to get above 2%. Now, with this change in policy, they want 2% on the core consumer expenditure deflator, not consumer price inflation, which is higher. We could talk about that, but consumer expenditure deflator, 2% through the business cycle, which means if you're in a period of sub 2% inflation, then you need to be in a period of above 2% inflation, so that on average it comes to 2. So inflation, part of this acceleration in inflation we're observing now is actually a feature, not a bug. The bug, and we're going from consistently below 2% now consistently above 2. And so, I would expect, when everything settles in, a desirable rate of inflation on the core consumer expenditure deflator to be 2.25%. And on the core consumer price inflation index, the index that we tend to focus on and people hear about in the news, is at least 2.5%. So, just saying. Here's the other thing, before I move on, one other data point people should have in mind. If you look at core, excluding food and energy, CPI inflation over the past 2 years through October, it's 3.1% per annum, right? So that's only 60 basis points, 0.6 percentage points above the kind of the target. And the reason is because people don't remember this, but if you go back a little over a year ago, inflation was very low. In fact, we were worried about disinflation and deflation because airlines and hotels and everyone was cutting price. And so what we're observing now in part is just a normalization in those prices as the economy comes back to full health. The final thing I'll say, Jim, is if I were king for the day, I probably would settle on a target inflation rate that's higher than 2, probably closer to 2.5 and 3. And 2 reasons for that. One, what you want is an inflation rate in overall across the economy that's high enough that there aren't any significant businesses or industries that are going to suffer any kind of disinflation or deflation, right? Because once you're in a deflationary world of falling prices, that makes it very hard on businesses. They have to do all kinds of weird things with their job, with their labor force and investment and everything else. So you want inflation high enough in aggregate so that no one is experiencing outright deflation. And the second thing I'd say is we are in a world of low interest rates. So we want to make sure that interest rates are high enough when the economy, to get there, you need a higher rate of inflation. You need higher interest rates so that if you get into a mess like a pandemic or just a classic recession, you have some room to maneuver and you don't hit that zero lower bound. So you get a little bit more, monetary policy latitude. So if I were king, I'd migrate that from, especially in the current environment, I'd probably migrate that up, from 2 to 2.5 or 3. There's some, transition issues you have to worry about, maybe infecting inflation expectations. So there's a lot of things to think about in that context. But if I could wave a wand and say, hey, where do I want inflation to land? I'd say 2.5 to 3, not 2.
Mm-hmm. So James, you were concerned about inflationary spiral. That maybe we have a lot of disruptions in the supply chain right now, but there is a tremendous amount of liquidity, and interest rates are basically zero. So, what if we are on a spiral? How do we bring that back under control? Federal Reserve has not raised interest rates yet. Government spending continues to expand. What package would you recommend to bring inflation down?
Sure. Well, I guess I would just first have to caveat the Mark was saying. I don't think we're at a point where we have a wage price spiral that is occurring right now. I guess and the response to avoiding it, or the key to avoiding it, is really the monetary policy response, and obviously tapering asset purchases. Just if you're in a hole, stop digging, stop adding fuel to the fire. That's the first step, and then obviously the next is normalizing policy. So I guess my concern, and this kind of feeds back a little bit to what Mark was saying with the average inflation target, is there's certainly positives to that if you have an economic situation in which you have deteriorated economic circumstances, you can allow policy to run accommodative for a little bit longer in order to make up for the gap where inflation was undershooting, and now you'll have inflation a little bit higher, and that should be helpful in terms of getting the economy back to full employment. But the risk there is the transparency is a little bit reduced. We're not sure exactly what is the average over. Is it over 12 months? Is it over 24 months? Like, what is the period in which inflation is supposed to average 2%, or is it how much above 2% is it allowed? So I guess I do worry a little bit if central banks are too far behind the curve, too reactive, rather than what has been the trend to be proactive, and maybe too proactive in the sense that they, in the recent history, the decade before the pandemic, raising rates in a way that actually cut off inflation and never even hit their 2% targets. We move now globally, really. All central banks are talking about sort of an average inflation target, and the ECB is similar. That if you get a little too reactive, that's where then you have to. I think the consequences are not going to be, to be honest, the consequences are not going to be hyperinflation. The consequences are going to be that the Fed then has to tighten quicker than they otherwise would have, and we have risk to the economy on the downside, because the Fed at some point gets religion and says, okay, we have to worry about making sure price stability, the core part of our mandate, is maintained, and then they raise interest rates quicker than they otherwise would, and demand actually takes a hit, and you have that all happen just as supply chains are being resolved, and that's kind of the downside scenario. I don't think there's a credible hyperinflationary scenario, but there is some downside risk to the economy from policy being too far behind the eight ball.
Mm-hmm. And Mark, what do you think? Should the Fed start raising rates sooner? And do you have confidence in their ability to act subtly, I guess would be the word that I'm looking for, so that they don't overcorrect too quickly?
Well, I'd say a couple things. One, first of all, there's no kind of wage price spiral evident yet so far, and that's why I ended my talk with a chart showing inflation expectations, because that's key to whether we do experience some kind of wage price spiral. Inflation expectations have to rise, and at that point, workers will say, hey, inflation is going to be high for a long time, Mr. Employer, pay me more, give me a bigger pay increase. Mr. Businessman or woman says, okay, I'll do that because I think inflation is going to be higher. I can pass that higher labor cost on to my customer. And the customer says, hey, I'm willing to pay the higher price because I know I'm going to get a higher wage. That's kind of the dynamic. And that dynamic is ignited by higher inflation expectations. And there's different ways of measuring expectations. My favorite way is looking into what investors are saying, because they're putting their money where their mouth is, right? And they're really thinking about this. And if you look at that data, the last chart I showed in my presentation, it's fine. It's like right on in the strike zone, exactly where, there you go, right where the Fed wants it. Somewhere, I remember I said 2.5% CPI inflation. This is inflation expectations for the CPI, consumer price inflation. We're not even at 2.5% yet. So I think we're fine on this so far. But this is critical. We need to watch this if inflation expectations start to rise, because, as James says, people are watching this all day long on the TV, and they begin to, this is here to stay, and then expectations shift. Then we got a problem. Now, having said that, given, if you buy into that kind of frame, at this point, I'd say the Fed is following its policy pretty close to doing exactly what it should be doing. It's starting, it ended its extraordinary measures and credit facilities back months ago, a year ago. It now is taking its foot off the quantitative easing. It's laid a path forward that it's going to wind down that QE by, I think, if you do the arithmetic, by June of next year. And then my sense is markets expect the Fed to start raising short-term interest rates, the Fed funds rate off the lower bound soon thereafter, 2 maybe 3/4 point rate hikes next year. That sounds about right to me. So it all feels roughly right. Now, having said that, the final thing I'd say is, at this point, I might be suggesting to markets and investors and everyone that, if I'm wrong and inflation isn't going to come in, and, I will pull forward how quickly I end my quantitative easing, and when I start to raise short-term interest rates, just to bring that a little bit forward. I don't think I think it would be probably a pretty good thing if they did that and long-term interest rates rose a little bit, take a little bit of steam out of asset markets. I don't know if you've been, you can see what's going on in the equity market. And I don't know if I'm sure you're even in New Jersey, you can see, here in Philly, for the first time ever, my house is appreciating in value at a double-digit pace. That has never happened in my entire life in Philly. So that gives you a sense of what's going on here. So I don't think it would be the end of the world if long-term interest rates went up, 25, 50 basis points, take a little steam out of particularly these asset markets. So, if I were king, I probably would guide markets in that direction to buy a little bit of, so-called insurance here. But broadly speaking, I think the Fed's policy is pretty much on track with, my expectations for growth and for the economy and inflation.
So I want to shift gears a little bit and talk about wages, and especially entry-level wages, because there's quite a bit of difference between an average increase in wages and the wage that it's going to take someone to get into the job market. And here in New Jersey, we are seeing really dramatic increases in those entry-level wages. So in the warehousing industry, a year ago, $15 an hour was the starting wage. Now it's 21, so almost a 50% increase. Bank tellers in many banks are up into the $20 range. Housekeepers at the Marriott's, $26 an hour. So these are really, really dramatic increases. And the question is, are they going to go down? When, there's always a stickiness on wages dropping, but it does provide people with a tremendous amount of income. And obviously, if you are paying your entry-level people these kinds of wages, and that doesn't include the signing bonuses that so many companies are now offering, but your legacy workers are also going to be looking for pretty substantial increases. So, is that going to add fuel to the fire, or just kind of average out, or could we potentially see a reversal where entry-level wages actually drop?
Well, maybe I'll just give it a quick go. I would say that the benefits of a tight labor market are that you have, especially the low end of the income distribution, start to catch up a little bit. And you can see that if you look at the Atlanta Fed wage tracker, which measures wage growth composition adjusted median wages by percentiles. We are seeing the fastest growth at the lower end of the wage spectrum. If you look at the data by sector, you're also seeing it in, as you mentioned, some of those lowest paid sectors. And some of that, I would say, is just the fact that they're high risk sectors. I mean, you want someone to come in and work in a place where their health risks are higher. I mean, you should compensate them for those higher risks. But I mean, I think, we have had, if you look at what was happening, I mean, the pandemic interrupted a lot of these trends, where in 2019, we had a really good labor market where the unemployment rate was, 3.5%, and you were actually starting to see real improvements in income inequality, and in terms of seeing the lower end of the distribution finally start to make some gains relative to everywhere else. And I would say that's a very good thing. And I would hope that, if we get to an economy in a year from now where the unemployment rate is 3.5%, that we continue to be in a world where, the economy is running hot and the gains are being more equally distributed, or maybe even going to what had been for a long time. I mean, what unfortunately, what interrupts that is the business cycle, right? If we have another turn in the business cycle, that's what would change that's where, the low end gets hit harder in economic downturns. So, hopefully we have a long expansion like we did prior to the pandemic, and some continuation of that trend happens.
Jim, just to point out that James did a good job of focusing on the Atlanta Fed wage tracker. I highly recommend that. Just Google it, and you can see, because it tracks the same workers and thus corrects for any mix effects that a lot of these other wage measures has. And you can clearly see that all of the acceleration in wage growth so far has been among low wage workers, folks in the bottom quartile, 25% of the wage distribution. For the rest of the workforce, it's not been significant acceleration in wage growth, at least not so far. I will say, to answer your question directly, I don't think those wages are ever going back. It's not like you got these pay increases. There's signing bonuses and other bonuses that are one time, but any increase in base pay, I'd be surprised if we see that come back in. But the rate of growth in future wage growth will slow as the pandemic winds down. People get back to health, their kids get back to school, there's small kids that are at home because they can't find childcare because those workers are sick. They'll get back to work and they'll re-engage with the labor market, and that wage growth will moderate going forward. The other factor I think is really important here that has been key to this acceleration in wage growth for low wage workers is the collapse in foreign immigration. So immigration was under significant pressure under the Trump administration because of policy, but then the pandemic hit and everyone erected, as you would anticipate, borders. It's very hard to move from one part of the world to another. So immigration really got nailed here in the United States, and we rely on immigration more than any other country in the world, developed world, for immigrants coming into the country. You can see the other country that also really also depends on immigration that's gotten hurt is the British, right? And that's because of Brexit. So they got really creamed because of the change in immigration law around Brexit. So, as immigration policy returns to something pre-President Trump, that seems to be, it's going to take some time for that to happen. And hopefully, as the world gets on the other side of the pandemic and immigration flows start to normalize, that should also take, a little bit of pressure off of low wages. But, fundamentally, the key here is the pandemic. That's really hurt those low wage workers, the people that are essential workers. They're out there dealing with people on a daily basis that face greater risk, and they have demanded higher wages to compensate for that. That's the fundamental reason for it, and wage growth there is not going to slow until we're fully on the other side of the pandemic.
Okay, so one last question, and then I'll give you both an opportunity to do kind of a summary real quick. But stock market, I haven't mentioned that at all. Inflation, good for the stock market or bad for the stock market?
You want me to take that, James?
Yeah,
Okay. Well, it depends. So far, the inflation has been good for the stock market because you saw these retailers, for example, in the last few days report blowout earnings. Now, partly that's because demand for stuff is very high, but it's also in part because they've raised prices for what they're selling and their margins are wider, and so their earnings reflect that. And at the same time, the higher inflation and it has not affected inflation expectations or long-term interest rates, at least not to any significant degree. I mean, the 10-year Treasury yield today, I just looked at it, is at 1.54%, which is incredibly low. So, the value of stocks is equal to the earnings discounted back by an interest rate. So if you do the arithmetic, so far, so good. Now, if inflation expectations start to get higher, again, going back to something I said in my presentation, and interest rates start to rise more, then that's going to be a problem for equity prices. And in my view, the stock market is very richly valued. The valuations are very high by any metric. They should be high because of low interest rates, but as rates normalize, stock prices will come under pressure. And the final thing I'll say is, if the Federal Reserve decides that it has to pull forward, expectations around when it's going to begin raising interest rates, which should presumably raise all rates, that's going to put significant pressure on equity prices. So I'll end this way, because I've been pretty upbeat all along. Let me end on a darker note. I would not be surprised that if in sometime 2022 we see a meaningful, sustained correction in equity prices. Not a bear market, but if you told me the equity market gave back 10% of its gains at some point for a few months in the middle of 2022, I would not argue with you.
Yeah, I wouldn't add much to that. I think that's right. That key will be, how smooth the transition to less accommodative monetary policy is. And when you've seen these when 10% corrections happen, every 18 months or so, we haven't had one really. I mean, we've been on a pretty good run since the pandemic, the lockdowns hit. But when you tend to get those, or when there's the tightening in financial conditions, and that tends to happen once once policies is starting to move normal. So that I agree with what Mark said there.
That means we're both wrong, James.
Yeah, probably.
Sorry to say.
So why don't we take a quick minute, Mark, start with you, and just let me know where you think we'll be a year from now, and what we need to do to make sure that that's a good place to be.
Well, Jim, thanks again for the opportunity. It was so good to be on with James. Really enjoyed the conversation and appreciate the opportunity. I'd say, in summary, the economy is still tethered to the pandemic. So goes the pandemic. So goes the economy. You could see that in with the Delta variant. It did a lot of damage in terms of growth and inflation, and scrambled things. So if the pandemic continues to wind down, goes in the right direction here, a year from now we should feel a lot better about things. I don't think at this point we can conclude that we'll ever be on the other side of this thing. I mean, I think this is endemic, and we're going to have to learn to live with it and adjust to it and adapt to it. And it looks like our technology is up to the task, but I think we will be at a place where we'll feel a lot better about it. But in terms of what it means for policy, I think the most important policy is doing the things to contain this virus. That means people got to get vaccinated. They got to mask up. They got to avoid big crowds, particularly in the middle of winter. They got to get their kids vaccinated. We got to get this pandemic down, and not only here in the United States. This has got to be global. I mean, when the U.S. has to take the lead in making sure that the vaccines and the antiviral drugs are available all around the world, because we're not going to get to the other side of this pandemic until the rest of the world gets there. So and there's no one better positioned to help the rest of the world get there except for the United States of America.
Mm-hmm. Thanks. And James.
Yeah, so I would agree on just the health crisis. I think should improve over the next year, and not be careful about making predictions on that, obviously, because we've had several waves we didn't expect. But treatments are definitely improving. We have booster shots going out. We have children 5 to 11 being vaccinated. We need to absolutely make sure that the vaccination rates pick up more in emerging market economies, because that is what is going to cause. I mean, that's what's caused many of the supply chain disruptions. And those will be vulnerable to that in a year from now if we're still looking at insufficient vaccination rates in many of those countries. So yeah, but if we get to a world in which the health pandemic is largely in the rear view mirror, then I think we're just thinking about the ways that, I think what's fascinating to think about is the way that the economy has maybe changed more permanently. And one of those, as Mark mentioned, is, people working from home. We've had proof of concept now for going on 2 years of people working pretty productively from home, and even just thinking through some of the other consequences of that for productivity in the economy. I mean, maybe I'd just like to leave on a positive note to say that, telehealth and many of these ways of delivering services digitally that we knew we could do, but we just hadn't tested out, and now we've done them. That could really be something that raises the productive potential of the economy in a measurable way. And a good way of reducing supply-demand imbalances by raising supply and higher productivity growth due to the greater adoption of digital technologies, as I said, in many of the sectors that actually have the lowest productivity and where the promise is the best. That could be really the light at the end of this tunnel.
Great. Well, I have to say, this is an outlook event. We're looking forward, and I think after listening to both of you, I'm feeling pretty optimistic about what's coming down. There are a lot of provisos in that, but I really want to thank both of you for taking the time to join us. This has been a terrific conversation. I have certainly learned a lot about it. And in our Economic Outlook series, we will be covering some other topics. We're going to have one on infrastructure constraints and on the labor market. So, we hope that people will join us for those as well. But again, Mark and James, thank you so much. It's been a pleasure talking with you today.
You too.
Good to see you. Take care now.
Okay.